ChatGPT hit 100 million users in less than 3 months. That is insanely fast. To put that into perspective, TikTok, the app famous for keeping people up way past their bedtime, took 9 months to hit the same number, and Instagram needed a whopping 30 months. In January 2023, BuzzFeed made a bold announcement. Much of its content would now be created with AI. Almost immediately, its stock price surged 150%. This graph tracks how often the word artificial intelligence has been mentioned over the past decade. For years, almost nothing. Flat, quiet, then suddenly a massive surge. Everyone was talking about artificial intelligence, and all the money started pouring in. Nvidia, the company behind the chips that power artificial intelligence. Its stock didn't just rise, it surged, up more than 400%. In a single day, billions of dollars were added to its value. It's not just a story about one company. It's a moment that feels bigger, like we're watching a new technological revolution happen in real time. But here's the twist. That very feeling might be one of the biggest misconceptions in investing. It's a classic mistake that's been repeated throughout history. And to understand why, we need to rewind the clock. In 1999, during the height of the dot-com boom, Warren Buffett noticed something familiar. History was repeating itself. He told a story, not about the internet, but about cars. Back then, cars were the new revolution. They changed everything. The shape of cities, the design of streets, even the speed of daily life. At the peak of America's industrial age, more than 2,000 car companies were fighting to win. If you had lived in that time, you would have been right to feel excited. It wasn't a trend. It wasn't a bubble. It was real. A true technological revolution reshaping the world. But here's the twist. Most of the people who invested in those car companies lost everything. This pattern didn't just happen with cars. In the 1800s, England fell in love with canals. Money poured in, a bubble formed, and then it burst. A few decades later, railways became the next big thing. Same story, excitement, overinvestment, crash. Fast forward to the 1990s. America saw it all again. This time it was the internet. Small tech companies promised to change everything. Money flooded in, the bubble grew, and then it burst. The Nasdaq, the main index for America's top tech stocks, lost more than 70% of its value. But here's what's important. These weren't fake revolutions. Canals opened trade routes, railways connected cities, the internet connected the world. They all changed the way people live. And yet, the investors who jumped in because everyone said this is the future were the ones who lost the most. Jeremy Siegel, a finance professor at Wharton, once wrote something surprising. Sometimes investing in a fading industry can actually earn you more than betting on the next big thing. Sounds wrong, right? But history keeps proving it, again and again. There was a time when railroads ruled the US economy. They were massive, making up 63% of the S&P 500, the backbone of American business. But over the decades, their power faded. By 2019, railroads were just 1% of that same index, from kings of industry to relics of the past. And here's the twist. If you had invested in railroads during that slow decline, you would have outperformed airlines, the very industry once called the future of humanity. Think about that. For your grandparents, flying across the world wasn't normal. It was science fiction. And yet, despite this revolutionary leap, the old iron rails quietly delivered better returns than the high-flying dream of air travel. In fact, railroads didn't just beat airlines. They beat the entire S&P 500. Here's another mind-bending example. Imagine it's 1971. You have to choose. Invest in software companies or oil companies. Most people would pick software instantly. It's exciting and it's the future. Oil, that's dirty, old, dying. If you invested $1 in software back then, by 2019, you'd have $74. Not bad, right? But here's the surprise. If you had put that same dollar into oil companies, you'd have $134, almost double the return. And this reveals a deep truth about investing. It's not about chasing what's popular. It's about finding what's undervalued. If you pay too much, even for the greatest company in the world, you lose. But if you buy something when it's overlooked and underpriced, that's where the real profit hides. The software industry? Brilliant, revolutionary. Everyone knows that, and that's exactly why it's expensive. Oil, on the other hand, dirty, outdated, unloved. And that's what makes it cheap. So the irony is, the stuff people avoid often makes the most money. So how do you actually invest your money? Well, there are three main paths you can take. First, you can trust the index. For more than a century, the S&P 500, a group of America's 500 biggest companies, has delivered about 10% growth per year on average. And the way to capture that growth is simple. Buy an ETF, a fund that spreads your money across all 500 companies. This is called passive investing. You don't need to pick winners. You don't need to time the market. You just hold, let compounding work its magic, and check back in 10 years. It's simple, it's reliable, and for most people, it works. Option 2, put your trust in a master investor, someone like Warren Buffett. Buffett is famous for one skill: spotting companies that are undervalued. He buys them cheap, holds them for years, and lets them grow. For over 60 years, Buffett has averaged 20% annual returns, twice the performance of the overall market. And joining him is simple. You just buy shares of Berkshire Hathaway and instantly own a piece of his carefully chosen portfolio. When markets crash, Warren Buffett's investments don't fall apart. Why? Because he doesn't buy what's trending, he buys what's true. Most investors chase hype. They buy at the top, panic at the bottom, and lose big when fear hits. Buffett does the opposite. He buys when everyone else is scared, when prices are low and the value underneath is solid. The companies he owns aren't built on buzz. They make things, they earn money, they survive bad times. So when the market drops, his portfolio bends, but it doesn't break, because real value doesn't vanish overnight. The third option, invest independently and aim to beat the market yourself. Most experts will tell you this is risky, and they're right. Passive investing is safer. But some respected investors believe that active strategies, when done skillfully, can outperform the S&P 500. Dr. Mohammed El-Arian, president of Queen's College at Cambridge, calls this the era of smart money. He warns that the future may look very different from the past, and that passive investing might not deliver the same strong returns anymore. Seth Klarman, one of the world's most admired investors, manages over $29 billion. Warren Buffett himself once said that if he ever retired, Klarman is one of only 3 people he'd trust to manage his money. And Klarman, he's been openly critical of passive investing. It's not just individuals either. Major institutions like JP Morgan, Vanguard, and UBS have all published reports warning that the S&P 500 may not deliver its historic 10% annual returns going forward. So why the concern? One of the simplest ways to judge if a company is overpriced is the P/E ratio, like price divided by earnings. For example, if a company earns $5 in profit, but its stock is priced at $100, its P/E ratio is 20. That means investors are paying 20 times the company's yearly profits. Now here's the problem. The entire S&P 500 currently has a combined P/E of around 28. By historical standards, that's very high. For context, other markets are much cheaper. China sits at 8, Qatar at 11, Egypt at 10. The US at 28 looks expensive compared to the rest of the world. Historically, the US market's average PE has been 15. Over the past 15 years, it's averaged 19. But today, it's 28, far above the norm. Think of it this way. A PE of 28 means it would take 28 years of the company's profits just to recover your original investment. Imagine buying an apartment for $1 million and only earning $10,000 a year in rent. It would take 8 years to break even. And now compare that to 28 years, and you see just how stretched today's valuations really are. This is why so many investors are worried. When prices get too far ahead of value, the risk of a major correction rises dramatically. At the core of it all, you need to understand one simple truth. A stock isn't just a piece of paper, it's a claim on a company's future profits. The key to investing is simple to say, but hard to live by. Buy a stock for less than it's truly worth, like paying 50 cents for a dollar's worth of value. If you pay a full dollar for a dollar's worth, you gain nothing. If you overpay $1.50 for a dollar's worth, you lose. But here's the challenge. To profit, you must be right while most others are wrong. For every buyer, there has to be a seller. If you win, they lose. That's why Warren Buffett famously said, "Be greedy when others are fearful, and fearful when others are greedy." Because when everyone agrees a company is strong, essential, and profitable, everyone buys it. That drives the price higher and higher until it's too expensive for you to make money. By the time you buy, the opportunity is gone. Aswath Damodaran, the professor of valuation at NYU, has a simple rule: any business can make you money, as long as you buy it for less than it's actually worth. Sounds simple, right? So you might think, okay, I'll just find companies with a low P/E ratio, cheap stocks, undervalued, everyone else is selling, I'll be the one buying. And honestly, that idea isn't bad. In fact, according to Sven Carlin, history shows it can seriously pay off. From 1966 to 1982, the Dow Jones Index basically went nowhere, 16 years flat. If you had invested $1,000 in the index after all that time, you'd still have about $1,000. But according to Sven Carlin's research, if you had instead invested that same $1,000 in companies with low PE ratios, you would have multiplied your money by 10. Low PE companies are often undervalued. Why? Because investors have low expectations for them. Think of it like a movie. If someone says, you're about to watch the best film of your life, your expectations skyrocket. The film has to be perfect to impress you. But if they say, hey, it's just an average movie, you'll probably enjoy it way more than expected. Low expectations create room for surprise. The same is true for companies. When expectations are low, even small successes can shock the market. This philosophy is called value investing. It's about finding companies that are undervalued, buying them at rock bottom prices, and holding until their true worth is recognized. It's not about hype. It's about patience, discipline, and risk management. Warren Buffett's entire career is built on this principle.